Srijan Singh wants to know which debt funds are better for 12 years investment horizon, dynamic bond funds or 10-year Gilt funds?
Well, that's a tricky question. And I think the answer would be much more complicated than giving this or that category of funds as an answer. So let me try to provide my perspective and the way I would approach this. What I believe is that for the core fixed income allocation of any investor, a bulk of that money should be invested in short duration funds. And more broadly, since long, we at Value Research have believed that by and large, the only two kinds of funds that any fixed income investor needs are liquid funds and an income fund. Of course, liquid funds are meant to park your emergency corpus or any money that you need within the next 1 year's time frame, while an income fund could be the one which is meant for your more steady state fixed income allocation. Now, the tenets that one should expect from this income fund would be of returns which are reasonably better than a fixed income over an investment horizon of, let's say, 2 to 3 years or more. And these returns, this fund should be able to generate without exposing the investor to any unwanted credit risks or too much of volatility with respect to the movements in the interest rates. Now, if we try and find out these tenets among the 16 categories of debt funds that are available these days, we believe that short duration funds come closest to playing the role of this classic income fund in an investor's portfolio. And that's why I believe that a bulk of an investor's money, or potentially all of the long-term fixed income allocation in one's portfolio, can be invested in these short duration funds. Now, of course, there would be times, there would be periods when these funds are primed to generate very low returns. And we are anticipating one such phase in the near future, in the, let's say, the next 1 year, where the returns of these funds may not be very substantial, more so in the context of the kind of returns they've been able to generate in the last 1 year. Now, some investors might be okay to live with that, ride through these periods of relatively lower returns with these short duration funds. But some other investors who would want to enhance their yields a little bit, now they have two options in front of them. One is that they assume a little more credit risk by investing in products like credit risk funds to generate or to boost the returns from their core allocation in short duration funds. Or the other approach that they can take is to add a little bit of duration to their portfolio. By that, I mean investing in funds which hold longer maturity bonds and which can yield slightly better returns. Now, out of those two approaches, we believe that it is not very desirable at this stage to take too much of credit risk, because economy is still in a recovery phase and the credit environment is still unfolding. So we believe it's avoidable to expose yourself to too much of a credit risk at this point in time. Therefore, a more viable approach to enhance your returns from fixed income allocation at this stage appears to be adding a little bit of duration to your portfolio, more so in the current context when the yield curve is very steep, which means that the relatively longer term bonds are yielding more attractive returns in the context of what short duration bonds have to offer at this point in time. So from that perspective, adding a little bit of duration to your fixed income investments may be a more viable approach at this point in time. And for that, one can look at adding a measured dose of products like dynamic bond funds or even certain corporate bond funds, which do offer those longer term maturities to one. But one should remember, by doing that, they would be also assuming a relatively higher degree of volatility in their portfolio, because these funds can be more responsive to the ups and downs in the interest rates in the economy. And in fact, investors may also need to manage these allocations a little more dynamically and consider shifting out of them when the interest rates start to increase. So to sum it up, what I'd suggest to him is to look at short duration funds to form the core of his fixed income allocation. And in case he wants to enhance his returns a little bit, then probably look to add a little bit of dynamic bond funds or some select corporate bond funds in a measured dose, but be willing to accept slightly high degree of volatility that would come with it.